When you deposit money into a bank, most people think it goes into a vault with their name on it. That the bank is storing it, keeping it safe, but that's not what's happening. The moment your money arrives, the bank is already lending most of it to someone else. This isn't a secret. It's not fraud. It's the design. Banks aren't warehouses for cash. They're circulation systems. And the reason your account balance still shows the full amount is because the bank is tracking a claim, not holding the actual money. Let's start with what happens when you make a deposit. You put $1,000 into your checking account. You can see $1,000 on your screen. You assume the bank now has $1,000 with your name attached, sitting somewhere in reserve. But here's what actually happens. The bank is required to keep a fraction of that deposit in reserve. Let's say 10%. That's $100. The other $900 can be lent out immediately to someone else. For a mortgage, a car loan, a business line of credit. That $900 leaves the bank the same day you deposited it. But your balance still says $1,000. Because the bank didn't give away your money. It created a loan using your deposit as the foundation. You still have a claim to $1,000. The borrower now has $900. Both exist in the system simultaneously. This is called fractional reserve banking. The term makes it sound complicated, but the mechanics are simple. Banks only keep a fraction of deposits in reserve. The rest gets lent out. And because your account balance is a claim, not a pile of cash, the bank can honor your claim even while your actual deposit is being used somewhere else. Now here's where it multiplies. That borrower who got the $900 doesn't keep it as cash. They spend it. Maybe they buy a car. The car dealer deposits that $900 into their bank account. Now that bank has a new deposit of $900. And the process starts again. The bank keeps 10% of $900. That's $90. The other $810 gets lent out to someone else. That person spends it. It gets deposited again. Another bank keeps 10% and lends out the rest. Your original $1,000 deposit just turned into $1,000 plus $900 plus $810, and it keeps going. By the time the cycle runs its course, that initial $1,000 has generated roughly $10,000 in total account balances across the system. This isn't magic. It's leverage. Every deposit becomes the basis for a loan. Every loan becomes a new deposit. And each new deposit starts the cycle again. The money supply expands not because anyone printed new bills, but because banks created new claims backed by the same underlying reserves. The reserve requirement is what keeps this from spiraling infinitely. If banks had to keep 100% of deposits in reserve, they couldn't lend. If they only had to keep 1%, the leverage would be extreme. 10% is a balance. Enough liquidity to handle withdrawals, enough lending to make the system profitable. But here's the critical part. At any given moment, the total amount of money people think they have in their accounts is far larger than the actual cash in the system. If everyone tried to withdraw their full balance at the same time, the banks wouldn't have it. Because most of it has already been lent out. This is why bank runs are so destructive. Not because banks are doing something wrong, but because the system depends on the assumption that most people won't ask for their money at once. The model works as long as deposits and withdrawals stay roughly balanced. The moment that balance breaks, the system freezes. So why is it built this way? From the bank's perspective, holding deposits without lending them is a loss. They're paying interest to depositors, even if it's a tiny amount. If they just stored that money, they'd lose money on every account. Lending it out generates interest income. The spread between what they pay you and what they charge borrowers is how banks make profit. From the economy's perspective, fractional reserve banking increases the money supply without requiring the government to print more currency. It allows capital to flow to borrowers who need it, which funds business expansion, home purchases, and infrastructure. If banks only lent out money they physically had on hand, credit would be far more limited and economic growth would slow. But this creates a fundamental tension. Your deposit is both yours and not yours. You have the right to withdraw it at any time, but the bank has already deployed it elsewhere. The system works because both claims are honored under normal conditions. You can access your balance. The borrower gets their loan. The bank profits from the spread. Everyone's claim is valid as long as the cycle keeps moving. The risk appears when the cycle stops. If a bank makes too many bad loans, borrowers default. The bank loses the money it lent out, but depositors still have claims on their full balances. If enough loans go bad, the bank doesn't have enough reserves to cover withdrawal requests. That's insolvency. The claims exceed the assets. If depositors panic and rush to withdraw, even a healthy bank can fail. Because most of the deposits are out on loan, the bank can't return everyone's money at once. That's a liquidity crisis. The bank has assets, but they're tied up in loans that haven't matured yet. This is why deposit insurance exists. In the United States, the FDIC insures deposits up to $250,000 per account. If your bank fails, the government guarantees you'll get your money back up to that limit. This removes the incentive to panic. If you know your deposit is insured, you don't need to rush to withdraw it when you hear bad news about your bank. Deposit insurance stabilizes the system because it breaks the feedback loop that causes bank runs. Without it, fear spreads faster than facts. One person withdraws. Others see it and withdraw. The bank runs out of reserves. More people panic. The bank collapses. With insurance, that cycle doesn't start. Depositors stay calm because their money is protected either way. But even with insurance, the core structure remains. Banks don't store your money, they circulate it. Your balance is a liability on the bank's books. The loans they made are assets. The difference between the two is the bank's equity. And the system assumes that under normal conditions, deposits and loans will move in predictable rhythms. Here's another layer that most people don't see. When a bank makes a loan, it doesn't hand over cash from the vault. It credits the borrower's account. The borrower now has a balance they can spend, but no physical money changed hands. The bank created that balance with an accounting entry. This is how most money in the modern economy comes into existence. Not through printing, but through lending. When you take out a mortgage for $300,000, the bank doesn't withdraw $300,000 from reserves and give it to you. It creates a $300,000 balance in your account and records a $300,000 loan on its books. You spend that balance and it becomes someone else's deposit. That deposit gets partially lent out again. The cycle continues. The money supply grows because banks create claims faster than reserves accumulate. And it shrinks when loans get paid off faster than new loans are issued. The central bank can influence this process by changing reserve requirements or interest rates. But the actual expansion and contraction happens at the commercial bank level through lending. This is why economists talk about broad money and narrow money. Narrow money is physical currency plus reserves. Broad money includes all the account balances that exist as claims against banks. Broad money is much larger because it includes all the leverage created through fractional reserve lending. Most transactions don't involve narrow money at all. When you swipe your card, no cash moves. Your account balance decreases. The merchant's account balance increases. Both banks adjust their ledgers. The reserves backing those claims don't move unless the banks need to settle imbalances between themselves at the end of the day. So what does this mean for your deposit? It means your money is simultaneously safe and deployed. Safe because your claim is protected by deposit insurance and banking regulations. Deployed because the bank is using it to generate returns. The system depends on this duality. If deposits just sat idle, banks couldn't function. If claims weren't protected, depositors wouldn't trust banks. The balance works because withdrawals are predictable in aggregate, even if they're random individually. On any given day, some people deposit and some people withdraw. The flows mostly offset. Banks only need enough reserves to cover the net difference, plus a buffer for unusual days. The rest can stay out on loan, earning interest. This is also why banks pay attention to the term structure of their deposits. Short-term deposits, like checking accounts, can be withdrawn anytime. Long-term deposits, like certificates of deposit, are locked in for months or years. Banks use short-term deposits to fund short-term loans and long-term deposits to fund long-term loans. Matching the duration reduces the risk of getting caught with long-term loans and short-term withdrawals. But even with careful management, the system has a built-in fragility. It works smoothly under normal conditions and breaks under stress. A recession causes loan defaults. A financial scandal causes panic. A sudden withdrawal spike forces banks to sell assets at a loss to raise cash. These aren't design flaws. They're features of a system built on leverage and confidence. The reason this setup persists is because the alternatives are worse. A system where banks hold 100% reserves would be safer but far less productive. Credit would be limited to the actual cash in the system. Loans would be scarce. Interest rates would be higher. Economic growth would slow. The trade-off is accepting some systemic risk in exchange for greater liquidity and access to capital. And the reason most people don't realize how this works is because it doesn't matter in daily life. Your balance is there when you need it. Payments clear, deposits are insured. The system hums along invisibly. It's only when something breaks that the structure becomes visible. A bank fails, a crisis hits. Suddenly everyone wants their money at once, and the reality becomes clear. The money was never just sitting there, it was always in motion. This is also why banking regulations exist. Capital requirements ensure banks have enough equity to absorb losses. Liquidity requirements ensure they can meet short-term obligations. Stress tests simulate crises to see if banks can survive shocks. These rules don't eliminate risk, but they reduce the chances of a single failure cascading into a systemic collapse. The system isn't designed to prevent all failures. It's designed to contain them. Individual banks can fail without bringing down the entire network. Deposit insurance protects individuals. Central banks act as lenders of last resort, providing emergency liquidity when markets freeze. The goal is resilience, not perfection. Once you see this, you stop thinking of your bank account as a storage unit and start seeing it as a claim on a moving system. The number on your screen isn't sitting in a vault. It's a record of what the bank owes you, backed by loans the bank made to others, backed by reserves the bank keeps on hand, backed by insurance the government provides if things go wrong. The system works because all the parts move together. Deposits flow in, loans flow out, interest accrues. Balances update. Reserves shift. And somewhere in the background, the central bank adjusts the levers, raising or lowering the cost of borrowing, tightening or loosening the supply of money, trying to keep the whole machine running smoothly without overheating or stalling. Your deposit isn't just your money. It's part of the fuel that keeps the entire economy moving. And the bank isn't just holding it. It's multiplying it, lending it, circulating it, using it to create more claims than there are actual dollars. That's not a flaw, that's the design. And it only works because most of us never ask for all of it back at once.